Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we're going to be talking about maximizing your technical analysis with options trading. Now, this is a pretty exciting topic for me to talk about because it really combines my life's work as a market strategist, first spending the first 7 years as a strategist in the currency markets, helping both retail and institutional traders better understand the markets and help them develop trading strategies. And that was a lot of work using charts and technical analysis. That's actually where I learned a lot of my charting skills, and then combining that with my option strategist role where we help you select the right trades to make off of those technical analysis work that you do. And today what I really want to do is really show you the power of options when they're utilized correctly, which will allow you to really maximize the work that you do as technical analysts. Because one of the insights and perspectives that I want to provide everyone with is the fact that many traders spend a disproportionate amount of time looking at their charts, analyzing indicators to get a sense for what directional view they may have on the underlying stock, and then only spend a few seconds on the actual trade. But in reality, where you're actually risking your money and where you're making your money is on the trade itself, not on the charting that you're spending a lot of time on. So today what I really want to do is make sure that we have a framework to evaluate every single trade that we make, so that you can decide or understand whether or not you're deploying your capital as efficiently as possible. Now, there are so many disciplines of technical analysis. I can't possibly cover them all. However, I will go over the broad categories and show you why different option strategies are ideal for different forms of technical analysis. I know many of you are using different types of indicators, different types of pattern recognition, all different types of strategies. I've seen them pretty much all. And I want to make sure that everyone understands what is the framework that you need to look at your technical analysis to decide what is the ideal option strategy to trade off of those technical analysis. So I'm going to spend most of my time today using the slides because the slides really allow me to teach different forms of methodologies and different why option strategies make sense for each one. But I will have a few minutes at the end to go through some real examples to show you using OptionsPlay. So let's go ahead and get started. I have a lot of things I want to cover here today. So first off, just a quick disclaimer. What we're going to cover here today is purely for educational purposes. It is not an offer or solicitation to buy or sell any specific securities. And for those of you that are brand new to OptionsPlay, welcome. For those of you that do not have access to OptionsPlay yet, which is the tool that we're going to show you here today, you could register for a free account using this tool, which will give you access to OptionsPlay, a tool that's designed to make your options trading as intuitive and as easy as possible, free of charge, courtesy of the Montreal Exchange for all Canadian securities. So you have free access to the Canadian platform, bi-weekly option education webinars like the one that you're on here, and a free on-demand options video library so that you can not only view options education live like you are doing now, but go back and review any of the pre-recorded webinars that we've done and allow you to utilize them free of charge. And with that, you also get some weekly cover call and short put reports for those of you that do sell options for either cover calls or cash secured puts. So let's go ahead and get started, and I will come back to this slide for those of you that want to sign up for this at the end. So I'm going to cover quite a few things here today. I'm going to start off by talking about what is the value of technical analysis? Why do I use it? What benefits do I derive from it? And more importantly, what are the different aspects that I get from technical analysis that is going to help me decide what is the suitable option strategy to trade? So once we cover that, I'm going to talk about 3 different option strategies today. I'm going to talk about 3 different ones because these are the primary ones that most of you will trade, and it gives you, and it sets up the 3 different scenarios that you may find yourself in when you're doing your technical analysis and why each one of them is suitable for different forms of technical analysis. Then what we're going to do is what we're going to do is we're going to run through a bunch of different technical analysis techniques, everything from price analysis and patterns, which are basic technical analysis, or price analysis that you would do, jumping over to chart overlays like moving averages that many of you like to use, before we move over to things like momentum indicators and leading and lagging indicators, to give you a sense for all, again, a broad category of technical analysis, and more importantly, how to apply each different option strategy to each one of these technical analysis methodologies. And then lastly, what we'll do is we'll go through some real setups using OptionsPlay and show you how you can use OptionsPlay to quickly identify the right option strategy for the outlook you have on the underlying stock. So starting off with the value of technical analysis. So technical analysis is really just the study of price history to try to forecast what is likely going to happen in the future. This is really believing that history may not repeat itself, but it certainly rhymes. So if you study what is happening in history, you can take those patterns and apply to what is likely going to happen in the future. Now, by studying technical analysis, the important piece is the fact that I get three very distinct things that are very important for trading. Number one, I get a sense for direction, because that is the start of every single trade. You need to first decide whether I think a stock or any asset that you're trading, whether it's a currency or a commodity or fixed income or equities, you have to first decide whether you think that asset is going to go higher or lower. And that's really part of the reason why we do technical analysis, is to get a sense for direction. Next, what's really also important for more on the risk management side is getting a sense for magnitude. Do I think the stock's going to go higher by 1% or 10%? And that's really where the magnitude portion comes into play. And lastly, do I think that 10% move or 1% move is going to take a day, a month, a year? How long is it going to take? And what technical analysis allows me to do is get a sense for direction, magnitude, and timing across thousands of instruments across every single asset class. And that's really one of the reasons that technical analysis is useful for me, is because back in the day when I was trading currencies, not only do we have to look at the currency markets, we really had to look at things like interest rates, commodities, anything that was tied to that specific currency. And technical analysis really was the only tool that allowed me to analyze all of these different markets and get a sense for direction, magnitude, and timing across multiple asset classes all at once, using the same discipline or the same methodology, which unfortunately you can't do with other forms of analysis. So the benefits is the fact that when you apply technical analysis in the ways that we're going to show you here today, it really provides you with an objective view on price, meaning you can get a very clear sense for whether you think the stock will go higher or lower. It doesn't mean that you're always right, but you will have an objective view as to where you think that stock will go. And like I said, it's really applicable to all instruments with a price. So regardless of what asset class you prefer to trade, you can utilize what we're going to teach you here today for any asset class. And more importantly, I think for many traders, is the fact that it's applicable to all time frames. Because the one thing is that we may all be trading equities, but some of us may day trade, other ones may be long-term investors. The moving averages that you apply to a 5-minute chart is just as applicable to a 1-month chart. So that's really the flexibility that technical analysis offers, is unparalleled to any other form of analysis. Now, it's really important to understand that just with any form of analysis, there are limitations. So many strategies tend to work best in certain environments. So it's really important that if you're going to use technical analysis for trading, to not only understand your strategy, but understand when your strategy typically works well and when it doesn't work so well, so that you can look back on some trades, whether you've made money or lost money on a trade, and be able to analyze whether the environment was the right environment for your trading. Because if it wasn't the right environment and you're losing money, that's okay. You can continue to trade and wait for the right environment. If you don't know what environments are good for your strategy, then as soon as you start having a few losing trades, you're going to start jumping ship. And if you do that, you're just going to find yourself constantly jumping ship from one strategy to the next. The second thing that I really want to, and it goes in line with what I just said, is the fact that I get a lot of questions regarding what is the best strategy or what's the best indicator based on my experience? And the answer is that there's no such thing as a best strategy or an indicator. As a strategist working with thousands of traders over the last few years, or last decade or so, I've realized that some of the best some of the best traders are not the ones that have lots of different indicators or have special indicators. Many of them use standard indicators with the most standard parameters on those indicators. What sets those users apart, from my opinion, is the fact that they use the same indicators day in and day out with the same, they apply the same indicators to the same trades every single day. They don't use the 50-day moving average today and then jump over the 200-day moving average the next day and then use RSI today and MACD the next day. They stick to one set of indicators that they understand and that they can rely on, and gain that objective view and understand that not every single trade you're going to be right on, that you're okay, that you're going to have losing trades, and they're okay with those losing trades, and they stick to the same indicators day in and day out. That's actually what I find is the most likely going to result in profitable trades in the long run than users who are constantly switching technical indicators from one to the from one to the next. So that's just my advice for those of you that are starting out and asking questions like, what are the best indicators to use? There is no such thing as a best indicator. Find a few that you understand, find a few that you can that you like, and stick to them. Because there's no such thing as a best indicator. You just have to find an indicator that suits your time frame. You just have to find an indicator that suits your trading style. So, if you're a long-term investor, you want to use a long-term moving average. If you're a day trader, you want to use a short-term moving average. This type of stuff, you'll find very, very quickly. But once you find it, try to stick with it. That's really what sets successful traders apart from others. So, with that, what I want to do is I want to jump over into the options trading piece. Now, before I jump into technical analysis, I will talk a little bit about what are the different types of analysis that you'll find yourself across. And what we have a segmentation here is what I find is that there's a clear segmentation for different types of technical analysis. So you're going to find yourself doing certain form of technical analysis where you get a clear sense for direction, meaning you have a clear sense whether the stock is going to go higher or lower, but you don't really have a clear sense as to whether it's going to go up by 1% or 10%, meaning the technical indicator itself does not give you a sense for magnitude. And there are many different examples of technical analysis that fall under this type of category. Now, when you find yourself in this particular category, there's really two types of trades that you might find yourself in. Either you think that the stock's going to make a quick move in one direction. You're not sure whether it'll move 1%, 5%, 10%. It could move a little, it can move a lot, but you do expect something to move relatively fast. Because it broke out of a range, or maybe there's some news that's coming out, or there's a catalyst, such as an event that you're waiting for where you expect a big move to happen. When you have a clear sense for direction, but you don't have a clear sense for magnitude, it's generally best to simply just buy calls and puts, because these have pretty good risk to reward ratio. They typically have a lower probability of profit, but they generally take advantage of a big, quick, and fast move in one direction or another. Conversely, you might find yourself where you have a clear sense for direction, but an unclear sense for magnitude, but this is a stock that you don't expect to have a big move in. You expect to have more of a neutral view. This is where you want to sell credit spreads. Now, if you don't know what a credit spread is, I will dive into a little bit on the next slides. However, I do have specific webinars just on each one of these three strategies. So if you want to learn more about these strategies themselves, please make sure that you look at our video library and take a look at learning about these specific strategies. Now, when you sell a credit spread, these typically have a poor risk reward ratio, but they're traded off with a really high probability of profit. So those are the two strategies that we typically look at when we have a clear sense for direction, but we don't have a clear sense for magnitude. And we're going to go over what type of scenarios we're going to find ourselves in where we have a clear sense for direction, but an unclear sense for magnitude. On the flip side, there's going to be technical analysis where you do have a clear sense for direction and you're going to have a very clear sense for magnitude. So you have a clear sense that this stock's going to go higher, and you have a clear target price as to where you think that stock will head in. For those specific trades, it's very clear that there's only one strategy that really makes the most sense for that strategy, and that's buying a debit spread. These typically have better risk-to-reward ratios compared to buying a call or put. So you have a better risk-to-reward ratio, and you generally have very similar lower probabilities of profit. So these two strategies are very similar, but they tend to be better when you have a clear sense for magnitude. And so with that, let's move on to some best practices for each one of these strategies. So like I said, this is just a review of these strategies. This is not meant to be a comprehensive understanding of these strategies. So if you want to learn more, please look at those webinars. So when we're talking about buying calls and puts, this is where we're expecting to profit from a large and a quick and fast move in one direction or another. General rule of thumb for these types of strategies is you want to buy expirations that are greater than 1 month out. You don't want to buy calls that are just 2 or 3 weeks out. You generally want to go a little further out in time. Even if you only want to hold on to the trade for a week or two, you still want to buy a 1 month option or 1.5 month option and sell it 1 to 2 weeks later. You always want to buy slightly in the money call or a put to start with. So about a 50 to 60 delta call or a put is a good starting point for when you're buying a call option. When you're buying a debit spread, this is really the same thing. All you're doing is basically still buying that long call or put, which is that 1 month, 50 to 60 delta call or put. The only difference with the debit spread is now you're going to sell an out of the money call against the long call or put that you've purchased. So you're going to sell roughly that 15 delta call or put. So a pretty far out of the money call or put that will basically help offset the cost of the long call. It will reduce the amount of time decay that you have on the overall strategy. And now your stock does not require such a large move in order for the strategy to break even. So both of these two strategies, because you're net long the option, you want to close these strategies before expiration date, either at a profit or a loss. But if you're buying a call or if you're buying a debit spread, you always want to make sure you sell off that position prior to expiration. Conversely, on the flip side, if you're selling credit spreads, that's where it's a little different. This is where you're profiting or you're trying to profit from a small or neutral move in the underlying stock. You want to sell relatively shorter dated options. So when you're selling options, you want to sell shorter dated options. When you're buying options, you want to buy longer dated options. This is really to maximize or minimize the effect of time decay. So when you're selling options, you want to maximize time decay. So you want to sell short dated options, usually 3 to 4 weeks out is a good starting point. You always want to sell the at the money call or put first. And then because selling that at the money call or put has unlimited risk, the reason that you want to buy an out of the money call or put is to reduce that overall risk from unlimited risk down to a defined risk. And we usually find that about a 25 delta call or put is a good starting point for buying that option. And these types of strategies, you'll typically see that for every $100 in income that you receive on a credit spread, you're roughly going to risk about $200 on that specific trade. So these have poor risk to reward ratios, but they typically have much higher probabilities of success. So because these are option selling strategies, you want to hold these until expiration and let them expire worthless. So unlike buying options where you want to close it before expiration, selling option strategies, you want to hold it to expiration and let it expire worthless. So those are the 3 strategies that we will take a look at here today. Again, if you want to review more, please watch our previously recorded webinars. But now what I want to do is I want to jump over to the technical analysis piece. I want to start taking a look at different ways to analyze the charts and understand what are the suitable strategies to trade. So we're going to start off by just talking about basic price analysis. And when I talk about basic price analysis, that means we're not going to take any indicators. We're simply just looking at the underlying price and getting a sense for direction, magnitude, and timing off of the price itself. So I have a chart here today. I'm going to be looking at support or resistance lines because that is the basic form of price analysis you can do. Support or resistance lines effectively tell you where buyers and sellers are likely going to step in. So a support line is where buyers are likely going to step in. Maybe I'll use a different color here. So a support level is when buyers are about to step in, and a resistance level is when sellers are about to step in, as you can see here. And this shows you historically where buyers have been and sellers have been, so that you get a sense for what is likely going to happen in the future. So right now what I'm drawing are horizontal support and resistance lines. I like to draw horizontal support and resistance lines because there are no subjectivity in that. When you can also do trend lines, you can do there's many other, you can draw channels. There's many different ways to draw support or resistance, but I like horizontal because there's no subjectivity in it. Whenever you get into trend lines, there's always some subjectivity into how you draw your lines, and I like to avoid that because I don't like things that are subjective. I like to have an objective view on things. So when I use a horizontal support or resistance line, I can use these lines to get a sense for when the stock bounces higher off of it, where I think it will go, when it bounces off of resistance, where it will go, and then so on and so forth. So when it bounces off this resistance level, I may expect the stock to fall back down to this support level. So there are a few different ways that you can really read support or resistance levels. One, you can believe that because of the fact there are previous support and resistance levels, like here where I have a pretty well-defined range, that means that I have a pretty clear target as to where I think the stock will go. For those types of trades, you're generally better off buying debit spreads, because you can buy the put option here and around this high, which was let's see, let me just move this. As you can see, this stock was trading between 40 and 48. So when it reached that 48 resistance level, you could have bought maybe a $48 put and then sold a $40 put to create that debit spread. This gives you a very, very efficient way to take that directional view, that bearish directional view. The other way you can look at this, and this is a slightly different way, but just as equally valid, is that when the stock reaches a support level, you basically you can say that you think it will bounce, but maybe you don't think it will bounce all the way back up to 48. Maybe you just think that it's not going to go any lower. You might think it's just going to stay somewhere within this range and just bounce somewhere in this 40, 42 level. If that's the case, you're better off selling credit spreads, because credit spreads will basically take advantage of this specific trade as long as this stock does not go through this support level. As long as the stock bounces off that support level, whether it bounces a lot or a little, you'll be able to take advantage of this trade. And the only time a credit spread loses money is if the stock plummets below that support level. So those are the different ways that you can utilize options to use price analysis and quickly get a sense for some directional ideas and directional trades to make off of it, simply based off of very clear support or resistance lines that are horizontal and do not require any subjectivity in drawing them. So with that, let's move on to the next category. This still relates to price action. We're just looking at those support and resistance lines in a different way. We're looking at breakouts and breakdowns. So we've identified a support or a resistance line here around this 87 level on this particular stock. So we think that the stock is going to stay below 87. But at some point, the stock breaks above that 87 level. So this is really where we expect the stock to continue moving higher. Now, when we expect a breakout, typically breakouts, keep in mind that we have a clear sense for direction, because when it breaks out, we obviously think it will go higher. But many times with breakouts, we may have a clear sense for direction, but we generally may not have a very clear sense for magnitude, because maybe it's reaching a new 52-week high. It's never been that high before, so you don't really have any reference points before that you can look back to say, how high do I think the stock will go? If it does have a reference point, then many times you might want to just create a debit spread. But if you're on a breakout to a new 52-week high and there's no preference or no reference point, you're better off simply buying a call option. Or you can sell a credit spread, because a credit spread basically says that as long as the stock doesn't go back below the 87 level, so now that it's above that 87 level, as long as it doesn't go back below this, I'm going to make money on the credit spread. So once it breaks above that resistance level, as long as you believe that new resistance level will hold, you can sell that credit spread, especially if you don't really think the stock's going to make a big move to the upside. If you think the stock might just move a little bit to the upside, as long as it stays above 87, you'll make money. This type of scenario, then you want to sell a credit spread. Otherwise, if you really think the stock's going to make a big move, that's when you might want to buy a call option. Otherwise, if this was a resistance level that held, meaning if you felt that this stock was just near that resistance level, and if it didn't break out and it started to break lower, that's when you want to buy puts and potentially trade a debit spread. So those are the different strategies and how you want to look at which strategy is best suited for you, because it really depends on your outlook on the underlying stock and whether you have a bullish or bearish view and whether you have a clear sense for direction and magnitude. Next, let's move on to chart patterns. And this is just a small sample of the different patterns that you may find yourself looking at on a chart. So many times, I think a very common one is double tops and double bottoms. The important thing to remember with these types of patterns, which are generally speaking reversal patterns, is that they give you a clear sense for direction. So a double top is clearly bearish, a double bottom is clearly bullish. However, just the double top pattern, the double bottom itself, does not give you a clear sense for magnitude. You may have previous reference levels to reference that give you a sense for target price, but that's only contingent upon having that previous level. Just keep in mind that the pattern itself does not provide you with the magnitude. So generally speaking, you're best selling a credit spread. So when you have that double bottom in a stock, so when the stock hits that double bottom, that bottom level is where you want to sell your credit spread. So at the bottom of this level, you want to maybe sell a put credit spread. And when it makes that double top, you might want to sell that credit spread up here near that top. So double tops and double bottoms, generally speaking, are best for option selling strategies. On the other hand, head and shoulders. Head and shoulders are a pretty clear reversal pattern that actually give you a very clear sense for direction, and they also give you a very clear sense for magnitude, because head and shoulders have a neckline. The neckline is actually the target price on that reversal pattern. So for those types of strategies, you're better off just buying a put option because you think that stock's going to head lower, or you can trade a debit spread because you have a clear sense for where the stock will go to the downside. Another reversal pattern that's very commonly used is cup and handle. This also gives you a clear sense for direction and a clear sense for magnitude, because the cup and handle gives you an extension that you can measure, and that gives you a target price. So for those, you're better off buying a call option or a debit spread, because you do have that clear sense for direction and that clear sense for magnitude. And lastly, continuation patterns. This is a pattern that basically shows a bit of consolidation, as you know, the stock may be rallying very strongly and then consolidates for a while, and then it's going to continuing rallying. So flags and pendants are patterns that let you identify when the stock is consolidating and about to break out again. So again, these types of patterns, clear sense for direction and also very clear sense for magnitude, because flags and pendants, you can measure the move of when the stock enters that consolidation period. And then when it does enter that consolidation period, as it kind of goes sideways here, you measure the size of that previous move. You can measure the size of that previous move to project out where you think that stock will go in the future. So this gives you a clear sense for direction and a clear sense for magnitude. So for those types of strategies, generally speaking, we find that buying debit spreads are a suitable strategy for these types of continuation patterns. So that is just a quick overview of different patterns that you might identify and the types of option strategies that make sense for these types of of technical patterns that you may discover. Next, let's move on to a very, very popular trading strategy, or a very popular indicator, the moving averages. Pretty much anyone who's ever read a technical analysis textbook, this is one of the first indicators that you learn about. And moving averages can be interpreted in many different ways, but most commonly it's interpreted based on the crossovers. So when the stock crosses below its moving average, that is a bearish indication. When the stock crosses above its moving average, that's a bullish indication. And you can trade these crossovers as bullish and bearish signals. However, one of the things that I think is most misunderstood many times about moving averages is that when you get a moving average crossover, keep in mind that that in itself does not show you any sense for magnitude. What I mean by that So here is a 50-period moving average drawn on a chart. So when the stock crosses below that moving average, just that crossover itself does not give you any indication as to whether this stock will drop 1%, 5%, or 10%. There's nothing in that crossover itself that tells you that. However, we do tend to find that many times when the stock crosses below its moving average, it tends to have maybe a relatively quick move to the downside versus a cross above the moving average. Many times that may be a bit of a slower move. So keep in mind that when you have a moving average crossover, you don't have a clear sense for magnitude. So many times you're better off doing strategies like buying a call or a put. So when the stock crosses below its moving average, you sell them. You buy a put. When the stock crosses above its moving average, you buy a call. Or the other way you can trade this is by selling a credit spread. So when the stock crosses below its moving average, so right here. So let's say the stock is trading around, where is this? About 184, 185 or so. So when the stock crosses below its moving average, you're basically saying as long as the stock stays below 184, 185, I can sell a credit spread here. So I can sell a call credit spread. As long as the stock stays below 184 and it doesn't move back above it, I can make money on selling a credit spread. Same thing here. When the stock crosses below its moving average again, I can sell another credit spread around 173, 174. And then when the stock crosses above its moving average, now I want to start selling put credit spreads. So as long as the stock doesn't go below this moving average, I can make money. And you can do this over and over again. So this is really where you can use these types of moving average crossovers to constantly generate income. So I can sell a call credit spread here, another call credit spread here. I'm going to sell a put credit spread here, sell another call credit spread here, and sell another put credit spread here. So in this particular chart with 5 different crossovers, I can sell 5 separate credit spreads. And this, again, takes advantage as long as the stock doesn't exceed that moving average crossover. And this is one of the best ways to use moving averages, not necessarily buying that debit spread or some of the other strategies where you need a clear sense for magnitude, because the crossover itself, and remember, does not give you a clear sense for magnitude. Next, what I want to move on to is Bollinger Bands. Bollinger Bands are an extension of moving averages, because what you're doing is you're applying a 2 standard deviation move on above and below the moving average. So many times Bollinger Bands can be used in many different ways, but one of the more common ways is to use them as a retracement. So when the stock exceeds its Bollinger Band, you basically expect that stock to pull back to its moving average. So when it exceeds that upper band, you expect it to pull back to that moving average. When it exceeds that lower band, you expect it to pull back to that moving average, and so forth. And you can do this many, many times where you basically, once it exceeds that band, you expect it to revert back to the mean. So this is a mean reversion strategy. And as you can see here, with these retracements, I get a very clear sense for magnitude, because when it's above its upper band, it's bearish. When it's below the lower band, it's bullish. And I also have a clear sense for a target, because the moving average themselves are the target price. So I have a clear sense for direction, and I have a clear sense for magnitude. So for that, it's best to buy debit spreads, because I'm able to trade that very efficiently using a debit spread, using Bollinger Bands for my trading strategy. So those are the lagging indicators, meaning they are using moving averages and Bollinger Bands are what we consider lagging indicators. Next, what I want to move on to are leading indicators, because these are by far some of the most popular trading strategies, some of the most popular indicators used by traders. However, I will say that these types of indicators are where I see most users misuse some of these indicators. And the one thing that's important to understand is that leading indicators such as MACD, RSI, or stochastics, and if any of you use these types of strategies, please type RSI or stochastics or MACD in the chat window, just so I know which one of these momentum indicators that you use. You can click on the chat window at the bottom of your screen. The one thing to really remember with these types of strategies is that these are indicators trying to gauge momentum, and they're trying to gauge whether momentum is slowing down or reversing, or whether they're heading higher or lower. And these indicators all range between an upper bound and a lower bound, and they simply just oscillate between these upper bounds and lower bounds. And they constantly oscillate between these two bounds. Now, the one thing to remember is that what they're doing is they're normalizing the price, and they're simply showing you the momentum aspect of that price. So the leading indicators that you use for trading, they only provide a signal for the momentum reversals, but it's really important to understand that they do not provide you with any sense for magnitude. So what do I mean by that? So when you get I have here at the bottom of a chart a stochastics. So when stochastics breaks below that 80 level, that's considered a bearish or sell signal. When it crosses above that 20 period, it's considered a buy signal. And many people use this indicator to decide when they want to buy or sell a specific stock or asset. However, it's really important to understand that when you get the sell signal, there's nothing that determines there's nothing the signal itself is telling you as to whether that stock is going to move lower by 1% or 5% or just simply trade sideways. You will get the same sell signal in any of these three scenarios. So you're going to get a sell signal as long as the momentum is does not continue to move any higher, but it's not going to tell you whether it's going to reverse lower. And I think that's where I think most users misuse these indicators, because when you get a sell signal on one of these indicators, it's not telling you that necessarily the stock's going to reverse lower. It's basically telling you that the stock is unlikely to move higher. And that's very different than saying that the stock will move lower. So with momentum indicators, there's really only one strategy that makes sense, and that's selling credit spreads. So when I get a sell signal, what you want to do is you want to sell a credit spread up here around that 380 level. So I'd sell a call credit spread. When it's near that bottom, I would sell a put credit spread. When it's near the top again, I would sell another call credit spread. Near the bottom, I would sell a put credit spread. Near the top, I would sell a call credit spread. Now, as you can see, almost on all of these trades, I would have potentially made money on this trade, because as long as the stock doesn't go against me, meaning in this particular case in the sell, as long as the stock doesn't go above this level, as long as the stock doesn't go below this level, as long as the stock doesn't go above that level, as long as it does not do what my arrows are pointing to, I can make money selling credit spreads. On the other hand, if I bought a call or a put, I would need a substantial move in the opposite direction, which does not always happen. Sometimes you do, but you don't always get a very strong directional move. Now, I did pull up a chart where you do get a clear sense for directional moves, but that is not always the case. And however, most of the time, when you do get these reversals, it simply means that the stock is unlikely to continue moving in this direction. So with that, selling credit spreads is a far better strategy for these types of leading indicators. So just to wrap up some of the things that I went over here today, remember, price is by far the most important indicator for you to use. You should use price as your primary way to determine your direction and magnitude. And any indicators that you add on top of that, whether it's moving averages or RSI or MACD, these should be only used to provide confirmation, meaning you should first have an idea as far as whether you're bullish or bearish based on the price, then use these indicators to confirm your views. As far as, I've seemed to have gotten a lot of questions already on what indicators are best. And the answer, again, is there's no such thing as a best indicator, and it's actually best to use fewer indicators, because that will allow you to avoid what we call analysis paralysis. When you have 3 momentum indicators, keep in mind that those 3 momentum indicators are meant to measure the exact same thing. They're just slightly different calculations to do so. So if you have multiple indicators, you might end up just confusing yourself. Stick to one momentum indicator. It'll make your life a lot easier. There will be less subjectivity to the directional views that you have if you only use one indicator. And if you use that same indicator day in and day out with the same analysis, you're likely going to be a more consistent trader in the long run. It's really important to understand your strategy fundamentally, because that allows you to look back on some trades, especially when you have a string of losses. That's where it hurts the most. And many times if you don't understand your strategy, you're not capable of looking back and saying, was this the right environment for my strategy? If it wasn't, then I can stick to my strategy and continue to trade it. If it was the right environment for my strategy, then maybe it's time to reevaluate my strategy or think about it, changing my strategy a little bit. But if you don't understand your strategy, you won't be able to look back and make those types of changes. You're just going to jump ship to the next strategy. And the second you have a string of losses on the next strategy, you're going to move on and next and next and next. And you're never going to find consistency as a trader. So whenever you trade using a technical strategy, make sure you understand why it works before you actually start risking your real money doing that. And again, staying consistent with the same strategy is by far the most important aspect to being successful in trading, in my opinion, aside from making sure that you manage your risk correctly. And some of the best ways to manage your risk is by using option strategy, because these strategies all have limited risk. So when it comes to selecting option strategies, make sure that you select your option strategy based on your outlook of direction and magnitude. Ask yourself, is the underlying strategy that I'm looking at, or the underlying outlook that I have on the stock, do I have a clear sense of direction, and do I have a clear sense for magnitude? If I don't have a clear sense for magnitude, there are certain strategies best for that. If I do have a clear sense for magnitude, there are other strategies for that. So making sure that you understand the relationship between risk to reward and probability is also really important, because selling credit spreads have very high probability, but they have very poor risk to reward. On the flip side, buying a debit spread has very low probability, but they have great risk to reward. So understanding the relationship between those two will help you determine when is the right time to sell credit spreads and when is the right time to buy debit spreads. And lastly, the best thing to do is to experiment with experiment with different strategies using OptionsPlay. And I have a few minutes here, and I can jump over to a few different ideas to show you quickly how to utilize OptionsPlay before I open this up for Q&A. So I was looking at, I think, BMO earlier today, because BMO is a stock that really has been just trading in a very tight range between this 98-101 type range. So, from my perspective, this is a very neutral stock. I don't have a strong directional view. I may have a clear sense for a direction. When it hits around that 101 level, I'm going to expect it to pull back, maybe a little back to that 99, 98 level. So this is ideal for potentially selling a credit spread. When the stock rises up to that 110 level, I can sell a call credit spread. So, or if the stock declines back to 98, I might be able to sell that put credit spread. So those are some ways that you can utilize OptionsPlay to allow you to look at these types of trades and say, okay, if I'm bearish on this trade, let me sell a credit spread. And you can use the modify button on any strategy to use the strategy constructor and construct a short call vertical here and sell that call vertical. That allows you to take advantage as long as the stock doesn't move any higher. Or when the stock is lower near that 98 level, maybe consider selling that put credit spread, so that you can sell a put credit spread that will take advantage as long as the stock doesn't go below a level such as, let's say, 98. So those are the different ways that you can utilize this tool versus a stock like, what was the other stock I was looking at here today? I think I was looking at some energy stocks. Energy stocks have really been falling apart here. So this is really a stock. It's a little late on the stock, but I saw this pretty strong support level around $40 that had been holding for quite some time that just broke below it. So this is an example of a breakdown, right? So 40 was a support level here, just broke it a couple of days ago, started to move substantially lower here. So, I may believe that this stock is going to continue moving lower. So with that, I'm going to look at my historical chart to say, are there any levels that I can reference previously as to my potential targets? So 37.5 and 35 or so, 35.5 are potential targets. This stock is clearly headed lower. Energy stocks have really taken a beating. I think a revisit back to 35 is a pretty clear target. So this is really where I would consider buying a debit spread, because I have a clear sense for direction and I have a clear sense for magnitude. If the stock does move down to that 35 level or so, 35.5, as you can see, 35.5. As you can see here, I'm risking $197 to make a $203 profit on this debit spread. which yields me about 103% return on this particular trade. So this is really where I want to make sure that I want to utilize debit spreads, because I could trade a put, but notice, number one, I'm risking more money on the put. And even if the stock goes in the direction that I expect it to, with the magnitude that I expect it to, I'm making $196 while risking 254. On the debit spread, I'm risking 197 to make 203. So again, even though we do a lot of work on these charts and we maybe spend a lot of time finding these setups and these really nice, beautiful setups, but if you're not trading, if you're not deploying your capital very efficiently and you just buy a put instead of looking at that debit spread, you might be leaving, number one, some money on the table, and you're risking more capital to make the same trade. So this is my point about analyzing your trade after you look at the charts, because you may be right on the charts, but you may be deploying your capital inefficiently. So you make sure that you take a look at OptionsPlay. That can help you understand your trades. I was looking at Barrick Gold. You know, mining stocks have really taken off with gold prices taking off. So this is a stock that really has made a new 52-week high. We don't really have any reference points to how high I think the stock can go. So, you know, do I think the stock can make a run at 24 or even higher as we kind of see you know, risk on, yet, you know, a lot of uncertainty in the markets, which is probably why gold and silver has really caught, you know, this huge bid over the last few months. So this is really where you can experiment to say, should I buy that call option, which will give me unlimited upside, or am I better off buying that call spread? And you can say, well, you know, even though I don't really have a template as to where I think the stock will go, this stock made a move from 19 to 22 or 23 over the last month or so. So even if it was to move another $4 to the upside, that's going from 22 to about 26. So as you can see, if it does make that big move, I'm better off buying that call option versus that debit spread. So here, I'm not saving much money. I'm risking 126 versus 103, yet the call option will give me an upside of 274 versus only 197. So because I don't really have that clear sense for magnitude, I'm maybe better off buying that call option, especially since I'm not risking too much more and I have potentially way more profit if the gold really just continues to move higher. So again, this stuff is, while it may come naturally to me, is something that takes time to learn, but OptionsPlay is really designed to help you put any two strategies side by side and allow you to compare them and see, based on your outlook, based on your magnitude, how much money you can make from each strategy, and more importantly, how much money do you lose from each strategy if you're wrong, so that you can really get a sense for whether or not you're deploying your capital efficiently as possible. And you know, if you do put up a trade like, for example, if I did put a short put vertical here, meaning if I did sell a credit spread, I can compare them side by side. I can say, okay, I'm willing to risk, let's say, $1,500 on this trade. So let me put the three side by side and say, well, I think the stock's going to rally to 25. How much money do I make? Would you rather sell a credit spread where you make $651, or do you want to buy that debit spread where you make $2,700? I think that this is pretty clear, because a lot of times I hear from users, oh, volatility is high, so I'm going to sell a credit spread. And I ask them, okay, volatility is really high and you've optimized the volatility piece, but have you considered, you know, the other pieces? And many times I hear from users that they're not. And many times you really have to put the two side by side to say, okay, yes, volatility is high, so selling a credit spread is great, but notice how much money you're leaving on the table. Just because you've optimized the volatility piece, you've completely ignored the directional piece. So instead of making a $2,700 profit, you're only making a $651 profit. I would certainly prefer to make 2,700 versus 650. So don't just look at volatility to determine what's the right strategy. Your directional exposure is always going to be the largest exposure you have with any trade. So make sure you use directional and direction magnitude to help you make your decision, not volatility. So I covered a lot of things here today. I don't expect everyone to memorize everything. I highly recommend that if you trade using technical analysis and options, to take the time to review the recording, which these webinars are recorded, and I will send to everyone within about half an hour after we finish here today. I just want to say thank you so much for everyone for taking the time out here this afternoon. I hope you really have found this useful. So right now what I'll do is I'll open this up for questions and answers, and I'll answer as many questions as I have time for here today. So if you have a question, please type them into the chat window or the Q&A window at the bottom of your screen. And thank you so much for everyone that provided your indicators that you use. And I will try to answer as many questions as I have time for here today. I know Peter asked before, what is the best indicator used for options? I hope I addressed that today, that there's no such thing as a best strategy. It's really about using indicators consistently and not about which indicators you use. Peter is saying, I have been using technical indicators for about 15 years trading stocks. How is it different using those tools while trading options? They're not different at all, Peter. I hope you realize that based on what we're doing here today is that the indicators themselves have not changed at all. It's just about understanding whether or not you're deploying your capital as efficiently as possible, based on whether the outlook that you have on the stock have any specific magnitude requirements. Peter's also asking, if trading options with the idea of closing it within a month, why not buy a 2 to 3 month option in case the stock doesn't move according to what you thought should have moved? Peter, absolutely. If your outlook is that you think that it will take at least a month to make the move, then you should be buying a 2 month option or maybe even a 3 month option. Just keep in mind that the longer you go out, the less liquid something is. So generally speaking, you want to stick to that around that 2 month option many times for most swing trades. You can always roll that option if you need more time. You don't have to necessarily buy that longer dated option. The longer dated option does put more risk on the table, so that's why you don't want to go too far out in time. Peter, I only trade options in registered accounts. I cannot use any type of option spreads. How can I use technical analysis using only calls and puts? So calls and puts are only suitable for very, very specific environments, which are very fast-moving environments. So if your technical analysis is showing you that you're expecting a small or neutral move, you would not trade options at all. You're probably better off buying that stock. So don't trade a call or put, even if you're bullish or bearish on it, especially if you're only bullish or bearish on it based on a little bit. Peter saying, is it a good idea to wait for earnings and trade after them? I trade after earnings all the time. It really comes down to more of a personal preference as to whether or not you prefer trading, if you want to take on the risk going into earnings or not. Lauren is saying, with debit spreads, is the maximum return the difference between the strike prices? Yes, it's the distance between the two strikes minus the premium that you paid. So here, as you can see, the difference between this spread is, let me first change this quantity to 1, just so it's easier to see. So the distance between the 20 to 22 is $3, but because I'm paying $1.03 for this spread, my max reward is the difference between the $3 and the $1.03 I pay, which is the $1.97. So with any spread, whatever you pay, the rest of it is your potential reward. If you're selling, whatever you collect, that's the most you can make, and the rest of it is your risk. So the distance between the two strikes will always determine the total amount that's at play, just that one half of it is yours and the other half is a risk. Stephen, thank you so much. I really appreciate it. Keith is saying, thank you for another excellent webinar. I would still like to connect with you one-on-one with my specific questions. I sent you a note a few weeks back. If you don't mind, I may have missed that email, so if you don't mind, send me the email at info@optionsplay.com. I can certainly try to answer any questions you may have. Daniel saying, new to options trading, having difficulty finding an online broker that allows trading of option strategies. Any recommendations? So I will actually open this up to the group. Does anyone here have recommendations for option trading brokers in Canada? I'm presuming, Daniel, you're in Canada. Part of the reason that we create this community is so that you guys can also communicate amongst yourselves. Matthew is saying TD Ameritrade. I don't know if I know many of you trade at other brokers. Peter is saying Questrade or BMO Online will trade any type of option strategies. So TD Ameritrade, Questrade, BMO, I know are ones that have been very popular. Another one, Vinod is saying TD or National Bank. What brokers offer platforms where you can do credit spreads? I believe that TD and Questrade are the two in Canada that offer electronic trading on multi-legs. IB also as well, so Interactive Brokers. Douglas is saying Interactive Brokers is definitely the least expensive. Matthew is saying Questrade is not good to analyze call option strategies. Now, Matthew, I haven't heard that before. If you don't mind elaborating a bit, I'm curious to see as to why you say that. Stan is asking what brokers offer platforms where you can do credit spreads. Oh, I think Matthew's saying I prefer Thinkorswim at TD Ameritrade. So it seems like TD was certainly one that has been brought up quite a few times, IB as well as Questrade. Any other questions regarding technical analysis or any of the option strategies we went over here today? Ash is asking, would it be a good idea to trade calls and puts around earnings season because of the increased volatility? So Ash, we actually have a webinar just on trading earnings. So I wouldn't say it's a good idea or a bad idea. It's a matter of whether you want to take advantage of increased volatility. Increased volatility, means that you have more opportunities to make money very quickly, but it also means an opportunity to lose money very quickly. Some people are not comfortable taking on that kind of risk. Other ones strive for that type of risk. So it really depends on your appetite for risk. I would say if you have a strong appetite for risk, earnings seasons is usually a fun time for those types of traders. For those that are wanting to reduce their amount of risk, earnings season is something that you may want to avoid. Matthew, Raymond, thank you so much. I really appreciate it. Vinod, any special considerations for day trading? So I am not a day trader. I used to trade very, very actively throughout the day using technical analysis, but I would say the best day trading instruments are the underlying itself. Options, derivatives are usually, generally speaking, not a good day trading instrument. So usually you would either trade the underlying stock. You may want to trade futures or spot FX. Those are good day trading vehicles. Options are not a good day trading vehicle. Where can I email you to ask a question offline? You can send me an email at info@optionsplay.com. I just sent it to everyone in the chat group. If you want to, oh, sorry, there was a typo in there. So info@optionsplay.com, that second link, you can send us an email if you have any questions. Any other questions before I sign off for today? Will we get the slides for the webinar? Yes. So in the recording, there will be a link to get the slides. So again, I believe I covered a lot of things here today. I, again, don't expect anyone to have memorized everything. So please take your time to review the recording as well as the slides. What do you think about weekly options? Weekly options, from my perspective, are no different than monthly options. They're just listed to give you more finite, better control over when your options expire. But from a trading perspective, they're the same as any other monthly option. When are you next in Vancouver for Options Education Day? The Options Education Day for Vancouver, if I believe, is at the end of November. I think it's like the weekend of November 30th or so. So make sure that you guys have that on your calendars. At the end of November, I will be in Vancouver for Options Education Day. The link will be sent to everyone once we finish here in about half an hour. So with that, again, thank you everyone for taking the time out here this afternoon. I really hope that you guys have found this useful. I will send out the recording to everyone in about half an hour. I hope everyone has a great evening. Good luck with your trading, and I will see you in 2 weeks. Have a good night.